Good evening, everyone. It's time again for our market analysis. Today, we'll continue sharing our short-term and mid to long-term views on Bitcoin and several major assets. As discussed yesterday, we asked everyone to initiate short positions around 2046. Those who followed should already be in profit. The next question is whether this position can continue to be held. Let's review why we chose to short at that level. Around 2050, the reasoning was not that we could predict a decline. Rather, the risk-reward ratio at that level was extremely favorable. After a long upper shadow appeared, that wick precisely tested the previous two highs. Did you notice that? That wick precisely tested the previous two highs. It hit that exact resistance zone. At that point, the key question became, would it break upward? Yesterday, I gave a detailed explanation. For those who missed it, you can review the prior analysis. The structure remains a weak consolidation, clearly weak. In such a consolidation phase, we should not rush to open long positions, regardless of fundamental headlines. For example, news about ETF net inflows or surveys showing stronger retail buying interest. There are always narratives suggesting that Bitcoin or Ethereum may have bottomed and are ready to go long. Is it possible that a bottom is forming? Perhaps, but based on actual price structure and chart behavior, it is still a weak consolidation. After undergoing a prolonged correction, can such a small rebound fully absorb all the overhead pressure and trapped positions? That is very difficult. Therefore, we classify this as weak consolidation. For Bitcoin, the structure is even clearer. On the 4-hour chart, if you zoom in slightly, you can see the consolidation is sloping downward. The trend lines are descending. That alone indicates weakness. In this type of structure, the default assumption should be weakness. How do you trade weak consolidation? You short at higher levels. The key is identifying a good high. What defines a good high? It is a level where your stop loss is easy to set, closely aligned with clear technical resistance. When your stop loss is well defined and tight relative to resistance, your risk-reward ratio becomes very attractive. This approach is not about predicting the market. It is about positioning correctly within the market structure. Accurate predictions have no value if the trade execution is wrong. What matters is making the right trade based on objective conditions. For those who opened short positions yesterday, can this position still be held? Yes, it can. However, this channel does not provide trade copying or direct trade signals. What we do provide are directional insights and suggestions related to position sizing and risk management. Yesterday, we explained that this level offered a very clear stop loss placement. Looking at the downside, the target could extend to the lower boundary of the channel. Even adjusting slightly upward, the move from around 2060 down to 1850 represents nearly 90 points of potential downside. On the upside, the space toward approximately 2132 is only about 50 points. So the risk-reward ratio is reasonably attractive. While it may not reach 11.5 or even 1.2, it is still tradable. Why is it acceptable to take this trade even if the ratio does not fully meet those higher thresholds? Because in a weak consolidation structure, if the weakness continues, the probability of a downside breakout is significantly higher than the probability of an upside breakout significantly higher. This is determined by market auction mechanics and liquidity preference. It is not based on mystical theories or magical rules. There is no magic in the market. The market operates on liquidity. Where liquidity is willing to flow, price will move. The market constantly seeks efficient pricing and areas of strong liquidity. This reflects the fundamental intention of capital, investors, and speculators alike. That is the core logic we discussed earlier. As of today, this position can still be held. How long should it be held? Continue holding until price moves beyond the midpoint of the overall range structure. Once price clearly crosses the midpoint of the box, your stop loss effectively becomes a take profit level. At that stage, you can begin trailing it downward instead of keeping it fixed near 2100 or 2140. After price moves beyond the midpoint, you shift your stop lower. At that point, it is no longer a defensive stop loss. It becomes a profit protection level. This is a basic but very practical technique. If price continues downward and breaks below the full range structure, you keep trailing the stop lower. The objective is to lock in part of the profit while allowing room for further expansion. You accept the possibility of giving back some unrealized gains in exchange for the opportunity to capture a larger move. That is the fundamental principle. In this structure, when should you consider exiting? The key reference remains the midpoint of the range, the area where trading volume has been most concentrated. If price moves decisively beyond that zone, your stop no longer belongs at the original level. Instead, you shift it down to the next structural platform. If price continues declining, for example, fully breaking below the entire range, then you continue trailing the stop lower, potentially relocating it back toward the former midpoint area. This way, you risk surrendering part of the profit in exchange for maintaining exposure to a larger directional move. These are practical trade management techniques. On this channel, we regularly share structured trading methods like these to help refine execution and risk control. Now let's zoom out to the higher time frame and make a medium to long-term assessment. There is actually not much new to evaluate today because there have been no significant bullish fundamental developments. On the contrary, the market feels very quiet. Even many crypto KOLs, vertical media outlets, and community channels are noticeably less active. In my view, that is not a bad sign. In every bear market, the true moment of despair is not simply about how negative sentiment sounds, it is about silence. Right now, we are not at that stage. One simple way to gauge sentiment is to observe social media activity. Watch how frequently major KOLs post. When the real bottom approaches, posting frequency drops sharply. Many start sharing unrelated or trivial content instead of crypto commentary. Vertical media outlets also slow down, publishing content that barely relates to the market. That is when you know sentiment is nearing exhaustion. We are not there yet. At the moment, people are still discussing whether this is a dip buying opportunity, whether fundamentals might improve, whether developments in AI or the US equity market could create positive spillover effects. That indicates the market has not fully reset emotionally. At least from a sentiment perspective, rebuilding is not complete. From a sentiment perspective, that's the current situation. But sentiment alone cannot be the sole basis for judgment. As mentioned earlier, from a medium-term perspective, could this consolidation produce a rebound? Yes, it's possible. However, the upside room looks very limited, roughly between 75,000 and 78,000. It may not even reach the prior breakdown level before the rebound fails. Let me show you, it might not even get back to this area before rolling over. Why? Because the overhead supply is extremely heavy. The trapped positions in this zone are the largest concentration. In some earlier areas, many leveraged traders were already liquidated, and during previous rebounds, a portion of trapped holders exited their positions. But in this region, there was substantial dip buying. A large number of participants entered here, attempting to catch the bottom. That means the supply overhang here is very strong. Only when price can truly push through and absorb this heavy trap supply will it become a genuinely bullish moment for everyone. Until that happens, the structure still qualifies as weak consolidation. So, what signals are we waiting for? First, a surge in spot trading volume that includes monitoring ETF flows as well as spot volume on exchanges. Second, a sharp deciphered decline, a strong flush lower. Ideally, those holding short positions can capture this downward move. But as always, shorting does not make you wealthy. A shorting is primarily for hedging risk. This is simply my view. The broader market cycle is not over yet. At the same time, there are trading opportunities every day as long as you stay disciplined and focused. That's all for today. We'll continue tomorrow evening.